The summary of Financial Intelligence, brought to you by Click-Through College. Chapter 1: The Art of Finance. Chapter 1 introduces readers to the realm of finance, emphasizing that it is more art than science due to the subjectivity and flexibility inherent in financial practices. The authors break down the barriers between non-financial professionals and financial concepts, demonstrating that accounting rules and principles can often be open to interpretation. The chapter also brings attention to key variables that impact a company's financial position, such as depreciation, tax regulations, and estimates. It advocates for developing financial intelligence to navigate this complexity and aid in sound decision-making. Chapter 2: The P&L Statement or Income Statement. The second chapter delves into the profit and loss statement, P&L, an essential tool that tracks a company's revenues, costs, and expenses over a given period. It explains the various elements of the P&L statement, such as sales, cost of goods sold, COGS, operating expenses, and net income. Readers learn how these components interact to determine a company's profitability. The chapter emphasizes the significance of the P&L statement as it provides a comprehensive view of a company's operations, showcasing how effectively it turns revenues into profits. Chapter 3: Balance Sheet. This chapter demystifies the balance sheet, a financial statement that presents a snapshot of a company's financial position at a specific point in time. It offers an in-depth analysis of assets, both current and non-current, liabilities, short-term and long-term, and equity, helping readers understand how these components interact. The chapter emphasizes that the balance sheet is built around the fundamental accounting equation: assets equals liabilities plus equity. It further explores the concept of book value, and explains how the balance sheet offers insights into a company's liquidity, debt, and overall financial health. Chapter 4: Cash Flow Statement. Chapter 4 explores the cash flow statement, a critical tool that tracks the actual inflows and outflows of cash within a company. The chapter is divided into 3 sections, corresponding to the 3 categories of cash flow: operations, investing, and financing. It highlights how a company's cash flow can differ from its profit due to non-cash expenses like depreciation and changes in working capital. The authors underline that a profitable company can still fail if it cannot manage its cash flow, emphasizing the phrase, "cash is king." Chapter 5: Ratios and Metrics. In the 5th chapter, Berman and Knight introduce various financial ratios and metrics. They explain the importance of ratios like liquidity ratios, current and quick ratio, profitability ratios, gross profit margin, operating margin, net profit margin, and efficiency ratios, inventory turnover, receivables turnover. The authors illustrate how these ratios, derived from financial statements, are essential for understanding a company's financial health, evaluating its performance over time, and comparing it against industry competitors. They also touch upon the concept of return on investment, ROI, a key metric used to evaluate the efficiency of an investment. Chapter 6: Deconstructing ROE, Return on Equity. Chapter 6 delves into the intricacies of return on equity, ROE, one of the most crucial performance metrics. The authors dissect the components of ROE using the DuPont analysis, showing how ROE is influenced by financial leverage, profitability, and operational efficiency. These elements provide a broad view of a company's financial health and its ability to generate profits from shareholders' equity. By understanding ROE, readers can glean insights into how effectively a company uses invested capital to generate profit. Chapter 7: Cash versus Profit. Chapter 7 explores the critical distinction between cash and profits. Profits are an accounting concept, reflecting revenues and expenses during a certain period. Cash, on the other hand, refers to the actual money that flows in and out of a company. The authors detail the cash conversion cycle, underscoring how companies often fail due to poor cash flow management, even if they are profitable on paper. The importance of forecasting and managing cash flows is emphasized as a vital element of financial intelligence. Chapter 8: Leverage. This chapter provides an in-depth understanding of leverage and its potential dangers. Leverage, the use of borrowed capital to increase the potential return of an investment, can be a double-edged sword. While it can amplify returns, it can also amplify losses and lead to financial distress if not managed carefully. The authors delve into various financial leverage ratios, such as the debt-to-equity ratio, to assess a company's financial risk and its ability to meet its debt obligations. The relationship between leverage, risk, and potential return is thoroughly explored. Chapter 9: Inventory and Receivables. Chapter 9 discusses working capital management, focusing on inventory and receivables. Effective management of inventory and accounts receivable can significantly improve a company's cash flow and financial health. The authors explain key concepts like inventory turnover, days sales in inventory, days sales outstanding, and their impact on cash flow. The chapter underlines the importance of efficient working capital management for liquidity, operational efficiency, and profitability. Chapter 10: Fixed Assets and Depreciation. Chapter 10 presents the concepts of fixed assets and depreciation. Fixed assets are long-term tangible assets that a company uses in its operations to generate income, while depreciation is the process of allocating the cost of these assets over their useful lives. The authors discuss different depreciation methods, such as straight-line and declining balance, and their impact on financial statements. They explain how depreciation influences a company's profitability and tax position, showing how companies use depreciation strategies for tax planning and how it impacts cash flows. Chapter 11: Amortization. Amortization, which refers to the gradual reduction of a debt over a given period, is discussed in Chapter 11. The authors explain that this concept applies not only to loan repayments but also to intangible assets like patents or goodwill, which lose value over time. Amortization schedules, which outline how much of each payment goes toward the principal and how much goes toward interest, are also introduced. This chapter provides a detailed understanding of how amortization affects a company's balance sheet, P&L statement, and cash flow statement. Chapter 12: Analysis Paralysis. In Chapter 12, Berman and Knight warn about the danger of overanalyzing financial data, a situation often referred to as analysis paralysis. They assert that while financial metrics and ratios are essential, getting too absorbed in the numbers can lead to decision-making paralysis or misinterpretation of data. The authors stress the need to balance detailed financial analysis with strategic thinking and to consider non-financial indicators of performance. Chapter 13: The Psychology of Finance. This chapter explores the field of behavioral finance, the intersection of psychology and finance. Berman and Knight highlight various cognitive biases, such as confirmation bias and overconfidence, that can skew financial decision-making. They argue that emotions and psychology can significantly influence financial decisions and, consequently, a company's financial health. The authors emphasize that understanding these biases can lead to better financial and investment decisions. Chapter 14: Financial Literacy and Company Culture. Chapter 14 underscores the importance of financial literacy across all levels of an organization. The authors posit that when employees understand the financial implications of their actions, they can make decisions that align with the company's financial goals. They also argue that fostering financial literacy contributes to a company culture of transparency, where employees feel more engaged and invested in the company's success. Chapter 15: Creating an Annual Report. In this chapter, the authors guide readers through the process of creating an annual report. They highlight the report's role as a vital communication tool for various stakeholders, including investors, employees, and customers. The chapter provides best practices for crafting a transparent and informative report, such as including not only financial data but also narratives about the company's accomplishments, challenges, and future strategies. Chapter 16: Finance for Entrepreneurs. This chapter serves as a primer for entrepreneurs on financial essentials. It provides insights into the unique financial challenges faced by startups and small businesses, emphasizing areas such as budgeting, cash flow management, capital raising, and valuation. The authors explore different financing options, including equity, debt, and bootstrapping, and their implications for a company's financial health. They underscore the need for entrepreneurs to have solid financial plans to attract investors, manage resources efficiently, and ensure the viability of their businesses. Chapter 17: Financial Traps. Chapter 17 identifies several financial traps that businesses often fall into, providing advice on how to avoid them. These traps include over-reliance on financial ratios, short-termism, prioritizing short-term gains over long-term stability, and ignoring non-financial indicators of performance. The authors highlight the importance of considering a balanced and comprehensive set of financial and non-financial performance metrics. They argue that avoiding these traps can lead to more sustainable business success and better financial decision-making. Chapter 18: The Bigger Picture. The final chapter of Financial Intelligence takes a step back to consider the broader economic and industry contexts in which businesses operate. The authors underline the importance of understanding larger economic cycles, industry trends, market dynamics, and their impact on a company's financial health. They argue that financial intelligence is not just about understanding one's own business but also about understanding its place within a larger ecosystem. This chapter emphasizes that by considering the bigger picture, businesses can better predict, respond to, and plan for changes in their external environment. In conclusion, financial intelligence offers a comprehensive guide for non-financial professionals to understand and use financial information effectively. It emphasizes that financial understanding is a necessary skill for everyone within an organization, not just those in financial roles. By gaining this insight, individuals can make better decisions, improve their organization's financial health, and contribute to overall business success. The summary of Financial Intelligence by Click-Through College.